Hello, everybody. This is Alan Gassman. Cameras aren't working. We're having issues with go to my messed up meeting, but we are. I'm here with Peter Farrell, and we're going to take you through the new tax law. If you started this and it didn't work out for you, I apologize. We're 13 minutes late, but better late than never. This presentation will not qualify for continuing education credit because it's not good enough for continuing education credit. There will be another, and by the way, we'll be sending you a video replay. There will be another webinar on Thursday, July 10, with Limeberg. It'll be 90 minutes with Brandon Ketron and Marty Shankman, and it will be more thorough and more organized than this one. I'll skip over the promotion of Estate View software, which we love, but I don't think we'll be showing it today. We could try towards the end of this. And the first thing I want to show you is the top 20 tax savers for taxpayers. And the first one, by far, which is $2.7 trillion over 10 years, is the permanent extension of tax rates. So this is the same tax rates that we've had since 2017. They're staying low where they were, the top bracket 37%. And if the Democrats take over in 2029, they'll just reverse that, and then there will be $2.7 trillion of more revenue. The second biggest tax saver is the increase in the standard deduction, which Peter's going to talk about a little bit. And Peter, it's hard to believe that that's $900 billion from increasing the income tax deduction that every taxpayer gets, whether they have interest deductions, medical deductions, or property tax deductions. But that's almost $1 trillion.
Wow.
The third one is the increase in the child tax credit, which is a big thing for the middle class. And then the fourth one, really interesting, the Section 199A deduction, where you have S corporation, partnership, or individual business income, active business income. This is going to cause a lot of landlords to become more active so that they can qualify for this 20% deduction. This is also just a continuation of part of the 2017 Tax Act. The House bill was going to increase the deduction from 20% to 23%, but the Senate bill did not do that. So what President Trump signed is pretty much the same 199A law. Peter's going to talk more about it. And then increasing the estate tax exemption, it was going to go down to half next year. Now it's going to be at 15 million per person, indexed with inflation as it was before. That's a $200 billion tax savings in the next 10 years for wealthy individuals who die and don't pay estate tax. But that could swing back if the Democrats take control again in 2019. And then increasing the property tax deduction to up to $40,000 instead of the former $10,000 cap is going to save taxpayers $142 billion. Repeal of personal exemptions, $120 billion, and then making permanent the ability to deduct the interest on an acquisition home mortgage for up to $750,000. That had been $1 million. They've reduced it to $750,000 of principal. Multiply that by the interest rate, and that's how much you can deduct for your mortgage interest as one of your itemized deductions. And Peter's going to explain itemized deductions in a little while. And then the piece limitation is a $90 billion tax savings. So you can look at the others. Now, number 14, and this is a really nice one. You'll now be able to deduct up to $1,000 in cash or $2,000 for a married couple for a charitable deduction, whether you itemize or not. So for people who donate $1,000, $2,000 a year, this is going to be a nice little thing. It's going to be nice for charities, and Peter's going to talk about that as well, because a lot of people are going to want to talk to their CPA about their annual gifting. This is going to change things. And then finally, number 19, I am very surprised that this is not a bigger number. This is where people are going to be able to deduct their boats and airplanes and expensive collector cars and RVs when you buy it this year for business purposes. Spend at least 500 hours on it because it's an active business. You can take the loss, and then later on in another year, convert it to personal use and pay rent to use it. So that's going to be a big thing for airplanes, boats, and the boat and airplane market. Peter, anything to add at this point? I apologize that we don't have camera.
Not at this point.
Okay, great. So what is permanent and what is temporary? This is important because we don't have to worry about it going away anymore. The estate and gift tax exemption going to 15 million is permanent. It goes from 13,990,000 per person to 15 million permanent. Then the bonus depreciation, apparently permanent, that you'll always be able to buy equipment and write the whole thing off. That's hard to believe. It's never been that way for more than a year or two, but that's what they've got. R&D deductions are enhanced permanently. The opportunity zone rule is now revised. It's made a little bit better here and there, a little bit worse here and there. But basically, if you used the opportunity zone law, if you took a capital gain after 2017 and rolled it into an opportunity zone investment, you still have to pay that capital gains tax after the 10-year period. They're not giving you amnesty on that, but now you can do it again for your future capital gains and get a 5-year deferral. So if you sell something for $100,000 and there was 40,000 of capital gain, you can invest $40,000 in an opportunity zone, pay no taxes until 5 years, and then if you keep the opportunity zone investment for 10 years, you can sell it and pay no tax. So those opportunity zones have done a nice job for a lot of people, and it's continuing. The qualified business income, that's your 199A deduction. Peter, do you want to talk about the standard deduction and give people just a little bit of background on it?
Sure. So this is available. Um, and if you do not want to itemize your deductions, you can take the standard deduction. It was increased in 2017, and it led to a lot more people choosing not to itemize and instead to take the standard deduction. This increase, as my understanding, is has been increased to, as you see there, $31.5 thousand dollars if you're filing jointly, and then from 2025 through 2029, they'll begin to phase out for individuals with incomes over 500,000. And then after 2029, that standard deduction will be capped at 10,000 for all taxpayers regardless of filing status or income. And then we have there at the bottom the current income tax brackets, and they were meant to expire after 2025 from the 2017 Act, and this new act makes those the new tax rates permanent.
Okay, so I'm going to go back here. So Marcia and I get a $31,500 income tax deduction regardless of our federal deductions for interest, property taxes, charity, and big medical expenses. If our combined interest, property taxes, charity, and large medical expenses do not exceed $31,500, then we just get a $31,500 deduction. On the other hand, if our interest expense is 10,000, our property tax expense is 10,000, and our charity is 50,000, then that's a $70,000 deduction. 70,000 is more than 31,500, so those deductions help us. And that's why Marcia and I make a large charitable donation every 4 or 5 years. Because instead of if we wanted to give charity $20,000 every year, it wouldn't make a big impact because it wouldn't get us much higher than 31,500. But if we give 100,000 every 5 years, then the year that we give the 100,000 will be well above the 31,500, and it will help us more. And we might even put off our property taxes. Instead of paying our property taxes in November for one particular year, we may pay 2 years and our charitable stuff all in the same bunched year. So that's the importance of bunching. And if you're single, then that standard deduction is $15,750. But now Marcia and I can give $2,000 a year cash to charity without worrying about bunching. It's the deductions above that where we worry about the bunching. And if we make a $100,000 payment, we can make it to our private foundation or we can make it to our donor advised fund. And that money can then later on be doled out to the charities each year. Peter, did I get that right?
Got that perfectly right.
I'm surprised. Okay. So we're going to talk more about the charitable deduction in just a little while. In fact, a little while's here. So this is Peter's slide. And Peter, go ahead and explain this.
All right, so there's some changes to the income tax charitable deduction rules, and they're separated, as you see on this slide, into 3 categories of taxpayers. So we have first the non-itemizers and the itemizers that Alan just talked about. So the non-itemizers are those who just take the standard deduction. They don't list out their charitable deductions and other deductions that Alan mentioned. So they take that large standard deduction, but on top of that, now starting next year in the 2026 tax year, if you make a charitable deduction of up to $1,000 for a single person or $2,000 for a joint filer, you can take an additional above the line deduction of those amounts, so up to $1,000 or up to $2,000 if you're a joint filer. If you make it has to be cash donation to your church, synagogue, another charity. This doesn't carry forward. There's some carry forward provisions we'll talk about with the other charitable deduction rules. That doesn't apply. So if you only give 500, or if you give 1,500 and you're a single person, you can't carry over that 500 to future years. And there's no floor, which we'll talk about for the other categories now have a floor. So that's for non-itemizers. Now, for itemizers, there is a new floor added. So now we're talking about people who are not taking that standard deduction. They're calculating all their deductions and taking that larger amount because it's over the standard deduction amount. Now, previously under existing law, there were some income limitations. So, for instance, if you gave cash to a public charity, you could only deduct up to 60% of your adjusted gross income. So if you made $100,000 in that taxable year, you could only take a deduction for those cash contributions of up to $60,000. So if you gave 65, you were limited to only taking a deduction of 60,000. But you could take that $5,000 extra and you get to carry forward that for up to 5 years. So if next year you still made the same $100,000, you gave less than 60 in cash to public charities, and you would be able to deduct that $5,000 in the next year. So that's the existing law, and those limitations haven't been changed. So we still have to do that test based upon those AGI limitations. What's different is that there was a ceiling, but now there's also a floor. So you can only deduct otherwise allowable charitable contributions to the extent that they exceed 0.5% of your AGI. I'll have some examples in a second. So to get to that, but now, if you had adjusted gross income of we'll talk about the examples, like I said, in a second, but of $1 million, your first $5,000 of charitable deductions, contributions are not deductible. If you'll just go back to the last slide real quick, Alan, please. Thank you.
I did.
And like I said, I'll give you examples in a second. So because there is a carry forward. And I'll explain the carry forward now, maybe. So the carry forward, you are able to carry forward that 0.5% that you weren't allowed to deduct, but you can only carry it forward if you had a carry forward under one of those other limitations. So in other words, you have to exceed that ceiling in order to carry forward the amount that was disallowed by the floor. And that might make more sense in an example in a second. And then for last category for corporations, so there was already a 10% limitation with the same 5-year carryover. So if a corporation had $1 million in taxable income, they could only deduct up to 100,000 in that year, but amounts over that they could carry forward for up to 5 years. Now, same thing, there's a floor. Their charitable contributions have to exceed 1% of that taxable income in order to take the deduction. Any amount that is below that 1% floor is not deductible. All right, now I'm ready for the next slide, which I made some examples to hopefully help to explain this. All right, so now we're to non-itemizers. Somebody has adjusted gross income of $100,000. They donate $1,000. That is a typo there. That was the old amount, but now they could deduct that $1,000 above the line. Now we're talking about itemizers. So we have a taxpayer with $1 million of adjusted gross income. That taxpayer has to donate over $5,000 before they get any deduction. If they donate $3,000, they get no deduction and no carry forward. If they were to donate $6,000, that's above the $5,000 limitation. They'll get a $1,000 deduction, but they will not be able to carry forward that $5,000 they were disallowed because they didn't reach, in this case, that $600,000 ceiling if this was cash to a public charity. But if they gave $650,000 cash to a public charity, we'd first apply that 60% limitation, so which would be 600,000. They could take the 600,000 deduction, carry forward the 50,000 under the previous law, but now we have that 0.5% floor, so they're limited to $595,000 deduction, but they get to carry forward both the 50,000 and that 5,000. I won't go. It's the same thing for corporations. It's just that we have a 1% floor and a 10% ceiling. Anything to add about that, Alan?
Is it simple enough? Oh my gosh.
I might be describing it maybe in a more complex way than it really is. But just think about it as there's a for itemizers and corporations, there's a floor, a new floor as well as the ceiling.
So if Marcia and I donate $2,000 to charity, we don't have to worry about our adjusted 0.5% of adjusted gross income.
As long as you're an itemizer, or not an itemizer. Sorry, you took the standard deduction.
You took this. Okay. All right. Very interesting. All right. Were you able to figure out the $1,700 credit? Can I give $1,700 to help some child go to a school and get a full $1,700 credit?
You can't pick the child, but yes, there's a lot of requirements though. So Alan's right. There is a new $1,700 credit if that up to $1,700 per year is given to what's called a scholarship granting organization. And if you look at the second to last bullet, I have the requirements. So that organization has to give scholarships to 10 or more students, and they can't all be in the same school. And for school, we're talking about elementary and secondary, K through 12. They have to spend at least 90% of their income on scholarships. It can only be for a list of qualified education expenses, and I have those listed on the next slide. There's a rule that if they have to prioritize students that they gave scholarships to before and their siblings. The amounts you give cannot be earmarked for specific individuals, so you can't give it and say, please give it to my son or my grandchild. And there's the children who receive the scholarships have to come from households that are below a certain income threshold. Also, in order for one of these scholarship granting organizations to qualify, the state in which it gives the scholarships has to verify and add it to a list of scholarship granting organizations. So your state has to opt in to the system and maintain that list. And you can also carry forward the amount. So if you give $2,700 in a year, you can carry over the $1,000 for up to 5 years. If you receive, you can't double dip, so you can't receive a charitable deduction and the $1,700 credit.
So I give $1,700 to this organization, and I get $1,700 back on my taxes.
Right, it's great. It's a credit.
Wow. And so I would think a lot of churches and synagogues and other religious organizations will set up these entities
Yes.
and to help students go to parochial schools and have their people who go to the church, the synagogue, encouraged to go ahead and give the money. The government gives it right back.
That's right.
That's amazing. That's a lot. Okay, so should we go to section 199A?
Yes, I don't have too much to say about this. If you studied and came to understand the previous 199A, there's good news for you. It's basically exactly the same, except the higher phase out amount. So the way 199A works is that there's a level of your adjusted gross income that if you are below that amount, then you're able to take. Alan mentioned the 199A briefly before, but that 20% deduction for qualified business income, regardless of the line of business that you're in. If you were above that threshold amount, there above the threshold to previously it was plus $50,000 for a single taxpayer or $100,000 for a joint taxpayer. There was sort of a phase out period, and then if you were phased out if you had what's called a specified service trader business, such as attorneys or accountants or football players, it would phase out over that phase out range, and then if you were over that amount, you no longer got the deduction. Also, if you're above the threshold, there were some W-2 income rules and phase out as well. Now, all they've done is just increase that range where the phase out occurs. So before it was 50,000 for single, now it's 75. It was 100,000 for joint, now it's 150. The second thing they did is there's a new floor. So if you have at least $1,000 of qualified business income, you're guaranteed at least a $400 QBI deduction. So it's now the higher of $400 or your actual QBI deduction. And those amounts will adjust for inflation, the 400 and 1,000.
Okay, so I think the biggest news here is that when this law passed in 2017, we were all really busy doing other stuff, and we didn't have time to set up separate little trusts for each child and grandchild and great grandchild and spouses of children and grandchildren to have part ownership in family businesses, which would save anywhere from $200 to $4,500 of income tax per child, grandchild. So a client with 10 grandchildren, we could set up 10 identical, simple little Section 678 trusts and save the family $50,000 to $60,000 a year. But the statute was temporary, and we were getting our arms around it, and we just didn't have time. Well, now we can go back to those families and tell them with some degree of confidence that this bill is here to stay, and that uh, we're going to save Medicare tax, we're going to save income tax, and we're going to save this tax because of the 199A deduction that the higher taxpayer parents or grandparents can't take because of their high income, if that makes any sense. And even for professional practices, we can set up management companies that have income and are partly owned by these lower bracket taxpayers. Does that make sense to you, Peter?
It does.
Super. All right, then I have more information on the charitable deductions. We just had some law students write this up in a way that may be more or less understandable. And now we come to tip income. Now, this became, according to President Trump, the reason he won Nevada is promising that there would be no income tax on tips. This will apply to categories of workers who normally receive tips that will be published soon by the Treasury Department. I'm expecting it'll apply to drivers and delivery people and bell people and uh, servers and bartenders. I doubt that it will apply to call girls or strippers, but it will be limited to $25,000 worth of income, and it will benefit people who are in the middle class and lower, single person up to 150,000, married people up to 300,000. So you won't be able to tip your CPA or your lawyer, unfortunately. I don't think that we will be on the list. Peter, anything to add to this?
No, I don't think so.
The one thing I was interested in, and I think a lot of people don't realize this, but when you go and you park your car and you give a tip to the valet or the bellman, they sometimes have to share these tips with companies that have the concession. So
Hmm.
I think the companies that have the concession may also not have to pay tax on the tip if the company with the concession is a proprietorship.
Oh,
So
wow.
I was looking at that. And then the no tax on overtime. Now this will only apply to people, individuals who make less than 150,000 a year or couples who make under 300,000. And the deduction is limited to 12,005 for a single individual or 25,000 per couple. But quite candidly, this one helps me because I'm hoping that more of my employees will let me pay them 12,005 or 25,000 of overtime because they won't have to pay tax on it. Now, I think it'll still be subject to employment taxes and it'll still be subject to pension contributions, but I personally like this one because I think it rewards people who work harder and put in more than 40 hours a week. What do you think, Peter?
I agree. I think a lot of people are excited about both of those new provisions.
Yeah. Peter, anything on the SALT, the increase to $40,000 of property tax bills? I know property taxes are going up because the cost of housing is going up, and this applies right this year in 2025. But anything to add to what I've already said about it?
No, I don't think I do. Of course, this was the big sticking point and the probably the most hotly contested item here. Um, But no, I don't think I have anything to add.
Yeah. Okay. So now the state and local tax deduction, just so people know, is it's property taxes plus the greater of sales taxes or state income tax. So if you live in New York, it's probably property taxes plus your state income tax. If you live in Florida, where there's no state income tax, then it's going to be property tax plus your sales tax. And you either know your sales tax because you kept track of it, or you get an automatic presumed sales tax amount. Is that's the way that works? Okay, the child care credit, I read about it, but I didn't really dig in too deep. But it's going to $2,200 per child per year for, and it starts phasing out when taxpayers have gross income above 200,000 for single filers and 400,000 for joint filers. So, and then up to 1,400 of the credit is actually a check. So if you have somebody who's a lower income and they have three children, 3 times $1,400 is $5,200, a check from the government that they may receive. So while you see Medicaid being cut by maybe 800 billion, you see this credit costing the government maybe 4 to 500 billion. I don't know how that's shared between people below and above the poverty level, but it is going to be a formidable uh, amount. And of course, now new uh, requirements that you have to have a social security number in order to get the deduction, etc. Peter, did you see anything on the deduction for seniors?
That is not one I've looked at yet.
Okay. Well, the story told is that Social Security is no longer taxable. And I believe I read last night that the Social Security Administration actually sent a blast out to Social Security recipients saying that under this new tax law, their Social Security was no longer going to be taxable. Instead, it is a $6,000 tax deduction, but it's reduced by 6% of your income over $75,000 for a single individual or $150,000 for anyone filing jointly. And it phases out entirely for those with income over 175,000 if single or $250,000 if joint. So I guess the result, we haven't run the numbers and we'll try to run the numbers this week, but it looks like the Social Security recipients who are under this 75,000 if single, 150,000 if joint are going to have enough of a deduction here to offset their Social Security income. Peter, Social Security is normally taxed at what, 85% of the normal rate? Is that the way it works? Do you recall?
I do not recall the rules for that.
Okay. All right. So then page 37, we've got the standard deduction again. And just for fun, we're showing some of the actual statutes here. There's the section 179 deduction. The section 179, 100% deduction on certain investments was at a maximum deduction of 1,160,000. Inflation adjusted, it got up to 2,000,008. Now there's a different and I guess a higher limit. And on Thursday, Brandon Ketron is going to join us, and we're going to talk a lot more about Section 179 and also Section 163J, which also provides large deductions when people buy capital assets. We've got the language of the bill here, and we'll be redlining the statute. I did some reading yesterday, and I like using the Perplexity AI. So I spent about 35 minutes looking at the statute and playing with the Perplexity AI. And we were able to prepare this article. It hasn't been proofread yet. But basically, for every U.S. citizen child born from January 1, 2024 through December 31, 2028, the federal government will put $1,000 into an account, and that account must be invested in the stock market, not bonds, but in index funds or similar funds that track the stock market. And then other people can contribute to that account. Although I don't think affluent people will, and I'll explain why in a couple of minutes. The child and the parents cannot touch that account whatsoever until age 18. I think that that's going to cause a lot of families to say, wow, look, $1,000 went into that account when that baby was born. It's 10 years later. It's worth $2,200. It's 18 years later. It's worth $3,500. Man, maybe I'll invest in the stock market. I think that's going to be a big thing. Secondly, it's there. You can add $50 a month or $25 a month. Whatever you add, it's going to be there, subject to the stock market when the child reaches age 18. At age 18, half can be removed. I think you need permission from the parents. I'm not so sure. And tax gets paid on the income when it's removed. So the child's born, the government puts in 1,000. I put in 3,000. There's 4,000 in there at age 18. It's worth 20,000. Well, you've got a lot of gain in there. 20,000 minus 5,000, 15,000 a gain. If it's spent on good stuff like education, you pay capital gains tax when it comes out. If it's paid on bad stuff like cars and going to the beach, then you pay ordinary income. With a 529 plan, you can take all the gain and spend it on education, and there's no tax. So I don't think anyone's going to be adding to these plans unless they really don't understand them or they're in very low income tax brackets. So there's no creditor protection laws yet for these accounts. I think that they probably will amend the bankruptcy code and the state statutes. A lot of them will be amended to protect these accounts from creditors, but right now they're not. So then when the child is 25, they can take the other half out. They have to take everything out by age 30. So it's a very, very interesting thing, but I don't think they're probably going to have to change it to make it more attractive to keep up with 529 plans. And then for 529 plans, they've made what I think is a nice change. The 529 plan can be used not only for tuition and living expenses for college students, but now also for vocational expenses that lead to a vocational degree or designation. So I think that that's a very nice thing that has been added to Section 529 plans. So this entire article on the Trump accounts came from about 45 minutes that I spent with Perplexity asking it to draft the article. Then I read it. I asked it to change this and that. I asked it to compare it to 529 plans. I corrected a couple of mistakes it was making. So pretty interesting drafting with AI. I wouldn't put $4,000 into one of these accounts. I would use 529 plans instead. With a 529 plan, the family can get hold of the money if they need to and have some of the money in bonds. So those are some reasons. Then an article that we have coming up on the 199A law is here. And let me see what we have next. All right. Next we have the interest deduction on your home, the home acquisition debt. Casualty loss deductions will be limited to federally declared disasters. So your personal little disaster will not get you an ordinary deduction. You'll need to be in a federal disaster. Um, Termination of miscellaneous itemized deductions, they're gone. Brandon will talk more about that. Anything having to do with the ecology or um, electric cars or qualified bicycle commuting reimbursement exclusions, that's all gone starting January 1, 2026. It's going to save about $500 billion in taxes, and it's going to result in fewer people having solar on their roof and having electric cars, but that is what it is. Interesting. If you are a professional gambler, you have a big income, a lot of revenue, you can only deduct 90% of your expenses. So if you have $10 million of gambling revenue and 9 million and $10 million of expenses, you're going to pay tax on $1 million. So this is going to reduce the number of professional gamblers, and maybe that's a good thing. That doesn't bother me at all, but I don't have any clients that are professional gamblers. Although I have a lot of entrepreneur clients who are professional gamblers from a practical standpoint. Um, Interest loan, car loan interest up to $10,000 of principal will enable somebody to write off their car interest, and I think that's a decent thing. Helps Americans get into cars that they may not otherwise have been able to afford. And it's a pretty, I don't remember how many billions of dollars of tax revenue is lost, but you can see it's really going to help a lot of people who have or will have small car loans. Um, then they enhanced elementary, secondary, and homeschool expense access for 529 plans. So there will be more things that you can pay for from a 529 plan, including homeschooling related expenses. We've got more on the Trump accounts there. You'll be able to use your HSA, your health savings account, for physical fitness expenses for up to 500 per person. And then we've got information on the opportunity zones. Where do we get a lot of this information, by the way, comes from a PDF of the House uh, bill. The House bill was the first bill that was passed, and then the Senate passed a different bill, and the president signed the Senate bill. But a lot of the provisions were identical between the House bill and the Senate bill. So what I put into my slides was the House bill descriptions a lot here, things that didn't change. Peter, I am pleased to tell you that you can go and get your indoor tanning now,
Wonderful.
and and you will not have to pay that 10% excise tax. So you can work on that tan before the wedding and really look good. Um,
Perfect.
and then all your clean car stuff, if you want solar, if you want an electric car, and there's any tax credit that can help you, you need to get it done this year. It's not going to be available after 2025. They tried to impose a big tax, in effect, on sports franchise purchases. They were going to disallow one half of the deduction for the cost of a sports franchise, and that would have been a pretty big tax on a lot of billionaires who buy sports franchises. That that made it in the House bill, but it was taken out by the Senate bill. So now anyone who's watching this webinar, if you buy a sports team, you'll still have a 15-year write-off. So if you pay $15 million for a soccer team somewhere, you'll have $1 million a year tax deduction. So that is what we have on the new tax. I had intended to show some illustrations on estate view, but I don't think, Peter, that we really have the ability right now to put that on screen. Am I right? Most likely.
We can try. I'm not confident it will work, but we can try.
Yeah. What would I press to do that?
I think you would press share uh, um, again, and it should give you options to share something else.
Yeah, they changed the platform, and our technical person isn't with us today. So, share, and I'm not very good at sharing anyway. That's what I've been told.
Mm.
Share screen, share screen. Did that do anything?
It looks like it is doing something. No, it looks like you're still showing the slides.
Okay. Well, I think conversationally, and I do apologize for those of you who are Estate View subscribers who came on to see the update. What I'm seeing is that there's problems with GoToMeeting with this platform we're using, so we may need to change platforms. But uh, I met with a client Thursday, and I said, "Look, I've got good news for you. Your net worth is 20 million. You've got about 1.5 million in your personal real estate and about 18.5 million in investments. And the exemption is now 15 million. It's adjusting for inflation. And based upon the amount you're saving and your rate of increase, I think you will not be subject to estate tax probably for 12 to 14 years." And they said that's a good thing. And we're pleased that we now have really more assets than we need. And I said, but if the estate tax exemption comes down to half in 2030, after the election of a Democratic president and a Democratic House and Senate, if that were to occur, then based on where you're heading, your estate tax in 20 years would be about $25 million. And they said, what can I do about that? And I said, well, what you might consider doing is let's have one of you put $3 million of investments into an irrevocable trust for the other of you and your descendants. So the wage earner, the bigger earner of the married couple, puts $3 million in a spousal limited access trust. If things don't go well, they can use the money to pay for spouse two's health, education, maintenance, and support, and half of the taxes. So really, spouse one has access to it. It's absolutely creditor proof. And in 10 years, it should be worth about 6 million. In 20 years, it should be worth about 12 million. And if one of you dies and the other remarries, it won't be lost to the new spouse. And the client just said, stop talking, I want it. So I think that maybe the standard of practice, I'm not sure, but I think we need to explain to clients that the Bernie Sanders proposals, the Elizabeth Warren proposals, the Joseph Biden proposals were for an estate tax exemption of 3,500,000. The law until this week was that the exemption was coming down to half from 13,990,000 inflation adjusted to just over 7 million. We got saved at the bell. It's not happening, but it could happen later. Also, later, you could have a wealth tax. You could have a tax where they just say, what's your net worth? Send us 4% of it so we can try to balance the budget. So I think on the estate and gift tax side, number one, don't unwind things that are already there that will be outside of the estate tax system, but start thinking about income tax basis. So the downside of that $3 million trust that's worth 12 million when the second client dies is that under the present tax law, there would not be a new fair market value income tax basis for those assets on the second death. So the children are going to pay some capital gains tax. What can you do about that? Well, you could consider putting life insurance in there because life insurance does get a new basis on the second death. People can consider private placement life insurance or very low cost life insurance wrappers for that. Another thing you can consider is put Uncle Floyd and Aunt Betty in that trust as beneficiaries and give them the power to appoint trust assets to creditors of their estate on death. And then when they die, you get a new income tax basis based on fair market value. So, for example, you've got a depreciated building, you put that in the slat for your spouse and descendants. Uncle Joe dies. Now you can start taking depreciation again based upon the increase in value. Maybe not as to the depreciation recapture component in that example, but that can be worth uh, considering. Or you swap back assets before you die. You put in high basis assets into that trust. You take low basis assets out. Another thing, Peter, that we'll need to be doing is contacting clients who have a lot of assets under holding companies, limited liability companies, limited partnerships to do away with the discounts. Right now, we have a lot of these entities, a lot of people listening to this have these entities where we've gone to great pains so that your $10 million holding company is owned, half of the voting power is owned by a gifting trust for your children, half of the voting power is owned by you, so that on your death, we could have valued that holding company at $7 million, taking a discount for lack of voting control. Well, now we may want to give you back the voting control so that if you die, we can get the full $10 million step up because we're not so worried about the estate tax anymore. So those are the type of things that we'll be discussing on Thursday in our Limeberg presentation. So, Peter, anything you want to add to that?
No, that's a lot of good things to think about.
Yeah, yeah. So, I do apologize to the attendees. We didn't have video. We started late. Go to my webinar has changed their platform, and apparently everybody is unable to show cameras today throughout the country. We will be reviewing whether to change our platform or other things. We were going to do a software extravaganza today, but I can't figure out how to show my screen to uh, make that happen. So uh, let's just instead have some wonderful time with your family, whether you want to or not. And we will be back next Saturday at 11 with our act together. We will be posting this to YouTube. I appreciate Peter waking up early and helping me with my slides. I appreciate Debbie getting here early and helping me with the slides. And I appreciate that I don't have to do any more slides because everyone else is going to do the rest of them
Mm.
next week. Uh, Thank you so much and have a wonderful day.